Most people, they panic during a market crash, but the wealthy, they prepare. So in this video, I'm going to show you exactly how smart money thinks differently and how you can turn a market crash into one of the best chances to build wealth in your lifetime. More millionaires are made during market crashes than any other time. Why we're seeing market volatility in Canada and the US. All right, let's talk about what's really happening. The US and Canadian economies are very, very tightly connected. Over 75% of Canada's exports go to the US. So when the US economy slows down, Canada feels it. Now, what's driving today's market volatility? First off, we have interest rates. The Federal Reserve and the Bank of Canada, which is a BOC, have kept rates high on purpose to combat persistent inflation. This makes borrowing more expensive, slows business investments, and dampens consumer spending. Second, recession fears. Economic growth is slowing. You're seeing it all around the board, guys, across different industries. These companies are cutting back. You're seeing layoffs across the board, across different industries and sectors. So earnings are missing expectations. You're seeing that as well too. And all this is adding to investor anxiety. And third, tariff tensions. As of today, this is a moving target, but these actions have disrupted supply chains and increased costs for both businesses and consumers. Fourth, geopolitical instability. Global conflicts and political uncertainties are shaking up investors' confidence, and markets absolutely hate unpredictability, and there's plenty of it going around right now. And finally, debt concerns. High levels of government debt and household debt in both countries in the US and in Canada are adding that pressure, especially with elevated interest rate costs. So remember, it's not just about the numbers, it's about the uncertainty, and markets absolutely hate it. The 4 types of market crashes. Now let's break down the 4 different types of crashes, because honestly, it's important to understand what kind of crash we might be in, as not all crashes are the same. So there's 4 different kinds of crashes. You have a correction, bear market, a full-on collapse, and black swan events. So first off, we have corrections. These are event-driven crashes. A correction is about a 10 to 20% drop, usually caused by sudden shock. Think wars, the pandemic, and even political surprises. So I want you to think the 2020 pandemic. It's a great example. Markets plunged and fast, but recovered just as quickly once government stepped in. And yeah, corrections are scary, but they are often the best times to buy because they tend to recover quickly. And we're talking about weeks to a few months. Bear market. These are a cyclical crash. A bear market is a drop of 20% or more. It's usually triggered by rising interest rates or slowing growth. But honestly, it's part of the natural economic cycle. So a great example would be the dot-com crash. Tech stocks were massively overvalued and there was a ton of zombie companies. Eventually, reality did catch up. These downturns last longer, typically 1 to 3 years, but the underlying system still works and eventually the markets bounce back. A collapse. This is a structural crash. This is a big one. It's deep. It's long, and it's caused by systemic failure. I want you to think 2008. The housing market collapsed in the US. Banks failed, and the entire financial system broke down. Canada was somewhat insulated, but cracks are showing, even more so today. These crashes, they can take up to 5 to 10 years to recover from. They lead to new laws, new regulations, and a ton of pain. They don't happen very often, but when they do, they leave a mark. Black swan events. These are rare, unpredictable, severe. They're events that no one sees coming. They're not part of the typical market cycle, but they disrupt entire systems, industries, and global markets. An example would be the 9/11 attacks, even the pandemic in its earliest weeks. It started off as a black swan. Honestly, you can't plan for them, but you can build resilience by staying diversified, holding some cash, and avoiding overexposure to any single asset. So the main takeaway here is each type of crash has its own fingerprint. But once you know what you're looking at, you can respond with clarity instead of panic. What not to do during a market crash. Now let's talk about what you should absolutely avoid during a market crash. Do not panic sell. This is the biggest mistake for many investors. When you sell in a downturn, you lock in your losses. Honestly, think about that. Remember, This is just a paper loss. If you're invested in wonderful businesses with fantastic fundamentals, the markets will recover, but only for those who stay invested. Don't try to time the bottom. Look, no one knows where the bottom is. Not me, not you, not experts, all right? And if someone claims they know, run away. They're selling you snake oil. Remember, most of the gains come early in the recovery. If you miss those, you miss the upside. Don't stop investing. Look, I get it. It's tempting to pause, to wait until things calm down, but you'll end up buying later at elevated prices. Don't ignore your emotions. The stock market is an emotional machine. It's okay. Fear is normal, but fear-based decisions will hurt your future. Acknowledge the fear, then stick to your plan. So remember, your mindset matters more than the market, because the stock market is often driven by irrational thinking and emotional reactions. What you need to do during a market crash. All right, let's flip it. Here's what smart money does when markets crash. Stick to or refine your plan. Look, if your portfolio is solid, stay the course. If it's not, this is your chance to clean it up. Trim the fat and double down on quality businesses. Keep dollar cost averaging. It's often referred to as DCA, dollar cost averaging. What you're going to do is you're going to specify a day in the month, usually at the beginning of the month, and then you're going to specify an amount to invest. No matter what the market is doing, you continue to invest, but you buy more when prices drop. Honestly, guys, this is the secret to investing and building long-term wealth. It doesn't get any easier than this. Buy quality on discount. You're going to want to focus on strong, proven companies. Think cash flow, low debt, and long-term growth. So if you're in Canada like me, you'll want to consider stocks that have dividend aristocrat or dividend king status. If you want to invest into the US, look into well-established blue chip businesses. And at the end of the day, these companies, they have proven history of financial stability and dividend payments. And trust me, dividend payments during a market crash really help with the psychology of investing. And lastly, you can look into low-cost ETFs that focus mainly on the TSX 60 and the S&P 500 for even greater diversification and protection. The main point here is you need to adjust your mindset to think like you're buying future income on sale. The stock market is the only market where people run away from when there's a sale. Build your dry powder. In market crashes, cash is king, and cash gives you power and it gives you opportunities. You can easily store this cash in a high interest savings account, which is also considered a HISA, but you can also put it in a short-term bond ETF. Either way, you'll want this liquidity easily accessible. At the end of the day, when everyone else is panicking, you'll have dry powder ready to buy, and you can back up that truck and start buying shares of your favorite businesses on discount. Keep learning. I want you to start studying past crashes. Keep these dates in mind: 1987, 2008, and 2020. They all look different until they start looking the same. Remember, crashes come, fear spreads, and then markets recover. Market crashes are wealth transfers from the impatient to the patient. Market crashes, they don't destroy wealth. They simply shift it. So here's the real question. Will you be the one who panics, or will you be the one who prepares? I want you to be the latter. So if this video helped you shift your mindset and you found value in it, feel free to hit the like and subscribe button. I really appreciate it. And honestly, share it with someone who you feel really needs to hear this right now, because there's a lot happening in the market and a lot of people need to hear this message. All right, this is Simply in the Black, helping you stay out of the red and into the black for good. I'll see you guys in the next one. So if you want to learn more about quiet wealth and the 10 invaluable lessons that taught me about money and true freedom, feel free to click on this video.